Okay, let's unpack this. We are diving deep into Rubrik Inc., ticker RBRK. Now, if you just look at the big picture for a second, cybercrime, well, it's projected to be this colossal $10 trillion economy by 2025. That puts Rubrik's whole mission-making businesses unstoppable smack dab in the middle of, well, arguably one of the biggest, most crucial spending trends out there today. It's not really optional spending anymore. So our mission here is to take all the latest research, this is current as of October 2nd, 2025, and really figure out, does this vital mission actually translate into an unstoppable investment for you? Right now, the stock's trading around, what, $82.41? And here's the interesting part, the hook, if you will. Our own educational discounted cash flow model, it's suggesting a potential value range, somewhere between $95 and $120 per share. That's, potentially significant upside. So what exactly is driving that kind of optimism? Today, we're really dissecting Rubrik, the business itself, the financials, the management team, the risks involved. Let's start right at the foundation.
Absolutely. Let's kick off with chapter 1, business understanding. So what's really powering their growth, it's this big shift, a really successful one, towards a subscription model. Investors love this, obviously, because you get that visible recurring revenue. And Rubrik's transition, it's pretty much done. If you look at fiscal year 25, their subscription revenue was $828.74 million. That's out of a total of $886.54 million. Huge chunk. And their subscription annual recurring revenue, the ARR number everyone watches, it just blasted past $1 billion, hit $1.25 billion as of the end of July 2025.
Okay, so that recurring revenue, that ARR, gives them stability. But let's face it, it's a crowded market out there.
Yeah.
How does their product, the Rubrik Security Cloud, or RSC, how does it stand out? Is it just about immutable backups? What makes customers stick?
Well, it's more than just backup. They position it as true cyber resilience. The foundation, yes, is that zero trust data security and those immutable backups. That's your absolute last line of defense. If ransomware hits, you know you have a clean copy to recover from. Guaranteed.
Right, non-negotiable these days.
Exactly, but the stickiness, that comes from how deeply integrated the platform becomes in a customer's IT setup. That means really high switching costs. And you see proof of that in their net revenue retention rate. It's consistently above 120%. Customers aren't just staying, they're spending more over time.
I get the defensive side, the backup and recovery,
Hmm.
but I'm also seeing reports, you mentioned acquisitions. They seem to be moving much more aggressively into the, let's say, proactive side of security. Companies like Predabase. That signals a shift, doesn't it?
Oh, absolutely. It signals a critical evolution. They're moving from just data protection to data intelligence. That Predabase acquisition is huge. It's about aggressive AI integration. They're not just stopping at immutability. They're using AI tools like Rubrik Radar for really fast ransomware detection and also data security posture management, DSPM.
DSPM. Yeah, that acronym gets thrown around a lot.
Maybe just quickly for listeners, why is just knowing where your sensitive data actually is so critical for stopping breaches? It's fundamental. You simply can't protect what you don't know you have, right? DSPM lets companies find and map out all their sensitive data, doesn't matter where it lives, SaaS apps, cloud platforms, on-prem servers. Having that visibility is crucial for compliance, yes, but also just for focusing your defenses where they matter most. And this whole AI strategy, this forward-looking vision, it's exactly why Gartner, for the 6th year straight in 2025, put them furthest along on the completeness of vision axis. The market sees where they're heading. They have over 6,100 customers globally now, by the way, with over 2,500 being large customers spending over $100K ARR.
Okay, that positioning makes sense. It's
Yeah.
not just backup anymore. Let's shift gears then from the tech to the people steering the ship. Let's talk chapter 2, management evaluation.
Well, starting at the top, you've got CEO Vipul Sinha. He brings a really valuable background, having been both a successful VC and an operator. So he gets both the capital market side and the, actually building and scaling a tech company side.
And that experience seems pretty deep in their security ranks, too. I saw their CISO, their Chief Information Security Officer, background includes time at the CIA. How does something like that actually help? Does it translate into real advantages for Rubrik?
It translates directly into trust and architectural rigor. In this industry, cybersecurity trust is everything. Having a CISO with that kind of deep government-level security experience, it really builds confidence, especially when you're selling to large enterprises or government agencies themselves.
Right, that credential matters.
It does. And that rigorous mindset, you see it in how they've handled incidents. They had a misconfigured server back in 2019, and then an issue with some log files breached in early 2025. In both cases, they were transparent, disclosed promptly, and importantly, third-party investigations confirmed that zero customer-owned data was ever actually compromised. It validates that their core security architecture is sound.
Transparency is definitely key there. Okay, so how are they using their money? Capital allocation. Are they spending effectively to keep that edge?
Yeah, they seem very deliberate. They talk about a buy-to-build strategy, so they prioritize funding their own R&D, but they also make strategic acquisitions to accelerate growth. You mentioned Predabase for AML. Before that, there was Datos.io, Laminar Security, which really boosted their DSPM capabilities. It looks like a cohesive strategy. They're buying pieces to integrate tightly into the main RSC platform, not just collecting random tech.
Okay, but we do have to address the elephant in the room financially. Their return on invested capital, ROIC, it's negative. That's bound to worry some investors, right?
It does, especially those looking for traditional value metrics. But it's pretty standard for a high-growth SaaS company in this phase. It's that J-curve effect. They're consciously choosing to reinvest heavily, sacrificing short-term profits to grab market share and fund all that R&D and M&A we just talked about.
So the bet is on future profitability.
Exactly. And the key indicator that suggests it could pay off is the gross margin. It's already strong, nearing 80%. That tells you the underlying economics of selling their service are healthy. It suggests they have pricing power and that once they choose to ease off the growth spending accelerator, profitability should theoretically follow pretty quickly.
Right, those underlying unit economics. Okay, speaking of the numbers, let's really dive into the financials now. This brings us to Chapter 3, Financial Analysis.
Okay, first thing to address is that revenue growth picture, because if you just look at the headlines, it seems kind of volatile. You saw this sharp deceleration in growth in fiscal year 24 down to just 4.7%. Then boom, fiscal 25 reaccelerates dramatically to 41.2%.
Yeah, that looks weird. What happened there?
It wasn't really about the underlying business struggling and then recovering. It was mostly an accounting artifact. It was the result of them successfully shifting away from selling old-style perpetual licenses, where you get the cash up front, to the subscription model, where revenue is recognized over time. That transition period makes the year-over-year comparisons look bumpy. The FY25 reacceleration basically confirms the subscription engine is now the main driver and it's firing properly.
Got it. So that explains the top line. Now the margins,
Yeah.
I called it a tale of two cities earlier.
Yeah, exactly. The good city is the gross margin. Very strong. Like I said, 79.5% in the latest quarter. And it's improving. That points to real pricing power. The challenging city is down the income statement. Operating margin, net margin, both deeply negative. Around minus 40% on a trailing 12-month basis.
Ouch.
Yeah. But again, that's the cost of growth. It reflects those massive investments in sales and marketing to capture this huge market, plus all the R&D needed to stay ahead on the tech side, especially with AI now.
Okay, but maybe the most critical financial story here is free cash flow, or FCF. You mentioned they turned positive. That feels like a major turning point.
It's huge, absolutely massive. This is probably the single most important financial development for them recently. After years of burning cash to fund that growth, Rubrik finally generated positive free cash flow in fiscal year 2025, came in at $31.3 million. That's the inflection point investors were waiting for.
And they expect that to continue.
Very much so. Management's guidance for this fiscal year, FY26, is $145 million to $155 million in positive FCF. Hitting that positive FCF mark proves the subscription model can scale profitably. It significantly de-risks the whole investment case.
Okay, so the cash flow picture is improving dramatically.
Yeah.
And they seem financially stable overall. Good cash balance.
Yep, quite stable. They have a net cash position, meaning more cash than debt, of roughly $350 million. And their current ratio, which measures short-term liquidity, is healthy at 1.82. Liquidity isn't an issue.
So how do you value this then? PE ratio is useless with negative earnings. What are people looking at?
Primarily price to sales, PS ratio. Currently, it's sitting around 14.4 times trailing sales. And yes, objectively, that is a high multiple, no question.
But context is key, right? Compared to peers.
Exactly. You have to compare it to other high-growth cloud and security names. Think Datadog, think CrowdStrike. Rubrik's PS multiple is actually lower than some of those peers. Even though Rubrik's estimated forward sales growth, around 39.2%, is currently projected to be higher than some of them.
So the argument is the high multiple is justified by that growth and maybe the AI potential we talked about. The market's pricing in future success.
That's the bull case, precisely. The market is betting that the pivot to data intelligence fueled by AI will unlock even higher margin revenue streams down the line, justifying paying a premium today.
And when you factor all that, the high growth but also the high risk, into an intrinsic value model like our DCF.
Right, our educational DCF model uses a fairly high discount rate, a weighted average cost of capital, WACC, of 10.5%. That reflects the stock's higher volatility. Its beta is up there at 1.68. Even with that higher discount rate, factoring in eventual FCF margin expansion towards, say, 25–30% long term, the model spits out that intrinsic value range of $95 to $120 per share.
Okay, so the model suggests the current price, around $82, might be undervaluing the potential if they execute on that growth story.
That's the key takeaway from the model, yes.
Yep.
Potential undervaluation if the thesis holds.
Okay, this is fascinating stuff. Now, before we get into how the market is actually behaving and the specific risks, just a quick word. Here's where it gets really interesting. If you're finding this deep dive valuable, and maybe you have a specific stock you want us to cover like this, please do like this analysis and subscribe to Stock Analytics AI. Our members, it's just €4.99 a month, get exclusive priority access. We're actually planning to cover all the S&P 500 stocks over the coming months, and members get first dibs on which ones we tackle sooner. Or, hey, if you just want a one-off deep dive on a particular ticker, you can always drop us a super thanks. We appreciate the support either way. All right, let's pivot now to how the wider market, how other investors are viewing Rubrik. Let's talk Chapter 4, Market Sentiment.
Well, if you look at Wall Street analysts, the sentiment is overwhelmingly positive. You've got a strong buy consensus rating. The average broker recommendation, or ABR, is very low at 1.29, which indicates strong conviction. And their average 12-month price target is hovering somewhere between $115 and $117. That implies, roughly 40% upside from where the stock is trading today. So analysts are definitely bullish.
Okay, bullish analysts. But that seems to clash with the stock's actual behavior sometimes. You mentioned earlier that plunge after the Q2 earnings. Down 18%, even though they beat estimates. That sounds paradoxical.
It is paradoxical. Let's call it the volatility paradox. And it's really important for potential investors to understand this. The paradox is, when a stock trades at a premium valuation, like Rubrik's 14.4 XPS, the market isn't just expecting growth. It's expecting accelerating growth, and it's pricing that acceleration in, sometimes perfectly.
So good isn't good enough.
Exactly. The stock sold off after Q2, not because the results were bad, they beat on revenue and earnings. It sold off because their forward guidance for subscription ARR, while strong, wasn't raised aggressively enough to meet those extremely high expectations. It just highlights how sensitive the stock is to sentiment and future growth narratives. Any perceived slowdown, even a slight deceleration in the rate of growth, can get punished really severely. It carries significant sentiment risk.
Makes sense. High expectations are a double-edged sword.
Yeah.
And adding to that pressure cooker, you've got short sellers involved too.
Yeah, the short interest is moderately high, around 8.61% of the public float. That means a non-trivial chunk of the market is actively betting against that premium valuation holding up. They're betting the growth story won't play out as perfectly as the bulls hope.
Technically. Where's the stock sitting now?
Technically, it looks like it's in a bit of a consolidation phase. It's trading just slightly above its 50-day moving average, which is around $81.64, but just below its 200-day moving average, around $83.95. Kind of caught between those levels right now.
Okay, so that's the market's view. Let's look at who actually owns the stock. This is Chapter 5, Ownership Structure. What you see here is generally pretty positive. First, high institutional ownership. Somewhere between 71% and 78% of the shares are held by big institutions. Think Vanguard, BlackRock, names like that.
Which lends credibility, right? The big guys are involved.
It does lend credibility. And second, you have a substantial insider stake. Management, founders, they still own a significant chunk, somewhere between 19% and 36%. That's generally seen as a good thing because it aligns their interests directly with common shareholders. They have skin in the game.
But what about insider selling? We often see headlines about that. Does that mean they're losing faith? Not necessarily. You do see some insider selling, but when you dig into it, a lot of it seems to be through prearranged 10b5-1 trading plans. These are plans set up way in advance, often for predictable needs like covering taxes related to stock compensation or just for personal diversification. They aren't typically timed based on some negative inside knowledge, so you have to take those headlines with a grain of salt.
Okay, that's helpful context.
Mm-hmm.
Any potential negatives in the ownership structure?
The main thing to be aware of is concentration. The top 19 shareholders control just over half the company. 51%. What that means is if just one or two of those very large funds decide to trim their position or rebalance their portfolio, their actions alone can have a disproportionately large impact on the stock price just due to the sheer volume they might sell.
Right. Big fish moving can make big waves. Okay, we've covered the business, the management, financials, market view, ownership. Now we absolutely have to look at the potential downsides. Let's dig into Chapter 6, risk assessment. Let's start internally. We need to be really clear about the weaknesses. We've touched on them, but let's list them out.
Sure. The big internal risks are pretty clear. One, the consistent JAP net losses. They're still losing money on an accounting basis. Two, the high valuation itself is a risk that premium PS multiple demands strong performance. And three, related to the losses, they have negative shareholder equity on the balance sheet because those past losses have accumulated. These are real financial risks that rely entirely on continued high growth to eventually overcome.
Okay, those are internal. What about external threats, the macro environment?
Yeah, the macro picture always looms. While cybersecurity spending is seen as more resilient than, say, advertising budgets, it's not immune. A significant economic downturn, maybe prolonged high inflation or persistently high interest rates, all those things could lead enterprises to scrutinize their IT budgets more carefully, potentially slowing down spending, even on critical security projects. That could moderate Rubrik's growth trajectory.
Makes sense. And you mentioned a specific geopolitical risk earlier related to tariffs. How does that play out for a software company like Rubrik?
Right. It's an indirect risk, but potentially relevant. The 2025 U.S. tariffs we've seen discussed, they mainly hit hardware servers, networking gear, etc. Now, Rubrik sells software, but that software needs to run on hardware that their customers buy.
Ah, I see. So if the hardware gets more expensive for the customer.
Exactly. If Rubrik's customers suddenly face, say, a 10% or 20% increase in the cost of the servers they need to buy because of tariffs, it puts a strain on their overall IT budget. That could indirectly make them a bit more hesitant to sign large new software deals with Rubrik, or maybe delay upgrades. It's likely a modest drag, not a deal breaker, but it's a potential headwind to be aware of.
Okay, a subtle but real risk there. All right, I think we've covered the landscape pretty thoroughly. Time to bring it all together.
Yes, let's synthesize all these pieces in the final chapter.
Let's wrap this up with Chapter 7. Conclusion.
Okay, so summarizing the bull case, Rubrik looks like a clear market leader in its space. That's validated externally by Gartner recognizing them as a leader for 6 years running with top marks for vision. They have what appears to be a durable tech moat built on that zero trust architecture, immutable backups, and increasingly their AI capabilities. Plus, those high switching costs keep customers locked in. And critically, the business model itself is now proving it can scale. That inflection to positive free cash flow in FY25 was a major milestone, and the guidance for FY26 suggests strong continued cash generation.
Okay, that's the bull side. Pretty compelling. What's the counter argument? The bear case.
The bear case really boils down to two main things: valuation and execution risk. That 14.4x PS multiple is demanding. It leaves very little room for error. Rubrik needs near-perfect execution on its growth strategy and its AI integration to justify that premium. And as we saw with the volatility paradox, the stock is incredibly sensitive to sentiment. Any perceived misstep or hint of slowing growth gets punished harshly by the market.
So it hinges on them delivering consistently.
Precisely. Which brings us back to our valuation summary. The current share price, around $82.41, is trading notably below our educational DCF model's estimated range of $95 to $120 per share. So the conclusion: Rubrik appears to be a high-quality company. Strong competitive position, critical market, good technology, improving financials. But for you, the potential investor, it absolutely remains a high-risk, high-reward proposition because of that valuation and sensitivity.
High risk, high reward. Got it. Okay, here is a final thought for you, the listener, to maybe chew on. Here's where it gets really interesting. Rubrik isn't just betting on having the best data protection. They're betting heavily on AI, remember Predabase. The real future battleground here might be about speed. Speed of detection, speed of recovery. So the question to mull over is, can Rubrik successfully leverage its massive data footprint and these new AI capabilities to become not just a data protection company, but truly a data intelligence company? Can they make recovery near instantaneous? That intelligence, that speed, that might be the ultimate moat going forward. Something to think about. All right, that wraps up our deep dive on Rubrik. Thank you so much for joining us. Again, if this analysis was helpful, please do consider liking, subscribing, maybe even joining our membership at Stock Analytics AI for just $4.99 a month to get priority access to our deep dives, especially our upcoming S&P 500 coverage, or drop us a super thanks for a one-off request. And finally, the important disclaimer. Please remember, this analysis was generated by an AI system purely for educational and informational purposes.
It is absolutely not financial advice. You must consult with a qualified human financial advisor before making any investment decisions based on this or any other information. Thanks again for listening, and we'll see you on the next deep dive.